All right, we're going to get started today by looking at the front page of Yahoo Finance. Yahoo Finance is one of the best websites for news about the stock market. Um, the most important things we see today are Trump's 30% tariff threat against the European Union and Mexico or Canada. So basically, we have um, we have Trump basically making um, announcements on a regular basis. And lately, the stock market is kind of shrugging its shoulders. Um, let me see, what other news we have today? We have 200% pharma tariffs are coming. So we have some intangible tariffs we have to deal with. Sometimes the headlines aren't actually what ends up being implemented. Sometimes it's just a negotiating point. So basically, it's our job as investors to look through that and to see good stocks that you can buy and hold. Let's look at the S&P 500. You can see that we're above the 200-day exponential moving average and above all the other moving averages right now, the 200, 150-day moving average, 100-day, and 50-day moving average. So we have positive momentum in the stock market. As long as we're above these moving averages, we're going to have momentum to keep going higher. And right now we're overbought, and we've been overbought for several months right now. So we are coming into a time of the year where it's traditionally seasonality wise not very good for August, September. So just beware, be ready if the stock market goes down during that time. Also during the summer months, we have very low volatility. So right now we have calm before the storm, perhaps. You can see in September and October, the VIX usually picks up and there's much more volatility in the stock market. So you got to be ready for that. All right, let's look at our calendar. Our calendar basically says we're going to have earnings starting to come out. This is a brand new earnings season starting with the banks. After this week of mostly bank earnings, we're going to have the tech stocks come out with their earnings in the subsequent weeks. So, so we have to be ready for that. A lot of times, earnings season is a good time, good reason for stocks to go up or down. So you got to be ready for with what stocks are really worth, and if they sell off in a major way, you got to be ready to jump in and buy. And let's look at the earnings that are coming out this week. This is from Earnings Whisperers. I found that on Twitter or X. You can see the banks start off on Tuesday. We have JP Morgan, Citibank, Wells Fargo coming out the same day. And on Friday, we have Charles Schwab, one of the stocks we're watching. We're gonna go over that today. And we have Bank of America on Wednesday. A lot of times the banks give you a good read on the consumer, and consumer is 70% of the economy. So um, we'll see what the banks say about how the spending is with the consumer. And we have Taiwan Semiconductor coming out with earnings on Thursday. A lot of times, whatever they say is directly applicable to NVIDIA because they do a lot of work for NVIDIA. So if they have really good earnings, NVIDIA will probably have good earnings too. Netflix has been down recently. They're going to be reporting on Thursday. So they've been pretty much overbought and extended. And this week they're giving some back. But last time, a lot of times Netflix earnings announcements usually agree with down 10% or up 10%. So we'll watch that. We also have Abbott Labs, one of the stocks we're following. It's one of the best performing stocks we're following this year. It's reporting on Thursday. They do a lot of diagnostic, such as COVID tests, and so there's some, and they also do some diabetes testing. So they have a niche in that environment. Let's look at our information for this week. The S&P down. It was very volatile this week, but it's down just a little bit from last week. Um, almost unchanged. We still have 61% of stocks above the 200-day moving average. So we do have some momentum. Both the 50-day and 200-day moving averages. Um, we have stocks over 60% above both averages this week. So that's a sign of momentum. So um, it seems like the um, stock market has momentum going with it. So we have the treasuries, um, they went up this week. So when the treasuries go up, the 10-year treasury yield goes up. That's usually an indication that home buyers are going to have a harder time buying a house. So there's not going to be as many houses sold. You're going to have a problem with lower quality named stocks. Yeah, let's look at the ramifications of rats. I missed it. Hold on. Well, we'll go over that later on. Okay, so whenever the yields go up, it changes the trajectory for a lot of things. Most common is the home sector. In the home sector, there's a lot of the economy that's built around the home, not just buying and selling homes, but uh, fixing up the home, buying things for your home. So that's a good part of the economy. So when that goes up, a lot of discretionary spending around the home goes down. And let's look at, okay, some of our biggest concerns this week are still tariffs. We've had two announcements Friday about 30% tariffs on European Union and Canada. That is a really big, and we're having a lot of the tariff announcements coming this week because there was a deadline. We're pushing them out again until August, but that's becoming a reason for the stock market to sell off. So be ready for that if it happens. Um, and let's look at, okay, our focus right now is to try to find low peg ratio stocks that are growth stocks with low valuations. And we're constantly monitoring the top holdings of the mutual funds and see if they find things that we aren't following. And or if we can find stocks that are quality stocks that are on sale, it's something we can add to our portfolios. Um, we're looking for safe business models, consistent performers over time, and we're looking for high yielding stocks and to add to our income part of our portfolio. Okay, so let's look at our average stock market returns. Okay, we're almost we're right in the middle of July, so that's typically a good month. We're starting earnings season this week, so that's a good reason for stocks to go up and when earnings are reported or go down. But we have a good setup for the rest of the month. We have earnings coming out, and we have possibly tariff situation under control by the end of this month. We don't know what's going to happen there, but that's a catalyst for stocks um, to go up. Then we have August, September, which are not so good months. Let me see. Okay, let's look at the S&P 500 trend lines. You can see that we're at the bottom of the trend line for the S&P. So you can imagine a zigzag like a saw going up. And so right now we have a upward trending market. We have higher highs and higher lows, and that's forming this uptrend. So we're right at the edge of this uptrend, and we're hoping it goes up to here next. And earnings could help that a lot. If we get some bad earnings and we break below this trend, then we might end up in this sideways pattern. It seems like we are in a sideways pattern here. We just broke through it, but let's see if we continue this uptrend. All right, so we are overbought. We've been overbought for 3 or 4 months now. Um, that doesn't mean that you sell. It just means be very cautious because a lot of times when in overbought markets, um, stocks correct. And right now we just had a start of some of the high flyers going down in a major way. So you can see, let's look at some of the high flyers from this week. Okay, you can see some of the ones I'm following, the high flyers. CoreWeave down 9%, Circle down almost 8%, QBTS, the quantum stock, down 7.5%. So you have a start of like this, the stocks that went up a lot, I mean exponentially in the past month are correcting a little bit. So there's a little bit of froth in the stock market and it's starting to come back to earth. But you'll find over time that the good stocks that grow like at 10% will continue to grow at that amount. And you can pretty much ignore the high flying stocks that are crazy that don't have any fundamentals. Okay, so let's look at the 10-year treasury. You can see that it's been going up this week, and you can see it's um, in a trajectory in a going up phase. It's in a one-to-one correlation probably in the last 2 weeks or so. That means as the yields go up, um, it's kind of flat with the S&P. We had an inverse correlation. Um, you can see there's a kind of an inverse correlation between higher yields and what you're willing to pay for the S&P 500. So we'll keep an eye on this right now, but right now yields are going higher. So we expect a lot of the stocks that need to borrow money, a lot of the sectors that require borrowing money, such as um, home building, not to do so good this week. All right, so let's look at their major market variables. The price of oil is $68. That's still pretty low. Um, and so it's not really a factor right now that's going to be affecting inflation or things in our portfolios. Let's look at inflation is basically still at 2.4%. So the tariffs haven't really hurt inflation yet. And the dollar is in a downtrend, but in this week it's actually gone up a little bit. So, but it's still, see, it's in a downtrend. So we're going to have earnings reported this week for next week and for a lot of multinational companies such as GE. We have Procter and Gamble. We have um, Microsoft. All the big tech stocks have a good portion of their money made overseas. When they repatriate that money, they're going to get like more. It's going to help their earnings. So the formula we have from Morgan Stanley, we are down. Let me see. Hold on. Let me see the formula we have. According to Morgan Stanley, every move up or down of 10% in the US dollar equals 3% help or hurt to the S&P earnings. So we can expect at least a 3% help to earnings for our multinational companies because of the weak dollar. So, so that's gonna be a tailwind for our companies. Let's look at what else we have to say here. We have gold is down just a little bit, 3% this week. and silver is doing really good. Let's look at the fear and greed index. We're still at extreme greed, on the edge of greed and extreme greed. So our formula is when there's extreme greed, take some profits off the table or don't buy. So we are, let's look at the amateur investor survey. We're bullish. 2 weeks in a row, we're bullish. Translation is take some profits off the table or don't buy. Okay, so we have the VIX is at 16. That is very complacent. So the stock market is not worried about any kind of crash. And it seems like the the stock market is conditioned to deal with tariff announcements. Even though we had a huge 30% announcement for tariffs against Canada and the European Union on Friday. European Union is one of our biggest trading partners, and so is Canada. For a 30% tariff threat, the stock market shrugged it off, which is pretty amazing. So we know from our, see, let's look at our, we know from our monthly um, VIX composite, this time of year we have very low volatility, but it does pick up as you get into September, October. So it's going to be much more volatile coming up. All right, so where are we in our emotional graph? Okay, so right now we have extreme greed. We're basically at the top here. We have a new paradigm. We have people talking about artificial intelligence, how that's changing everything. We have the AI infrastructure built out, and people are just excited. So right now we're at the top, basically, starting to go down. Maybe a bad earnings report might give us some denial. So the things we're worried about for the stock market, the weak dollar brings up the cost of commodities. So we're going to find as the dollar continues to weaken, the price of commodities should go up, such as gold and silver. And let me see what else. We're having tariff threats. So we have to, as we have tariff announcements, we have to like figure out on a napkin how this affects the stocks that we're holding. And we had NVIDIA come out this week and said, don't worry about tariffs. We can make it through and it's not going to affect our business that much. That is a huge hint from the CEO of the company. If we get a tariff tantrum again, where we have tariff um, issues, watch NVIDIA. If it sells off, then, we were saying when it was selling off that it doesn't have many problems with tariffs. So let's look at, okay, we're overvalued right now still. The PE ratio for the S&P, according to the Wall Street Journal, is 24.69. That is elevated, and we can't stay elevated for a long time. I don't know. I like to think of things in terms of fair value. So for fair value, we're 20% over the fair value right now for the S&P 500. Um, so you have to keep that in mind and adjust your expectations. Okay, I highlighted the worst to first. So right now we have the best sectors in the market, industrials. Why are the industrials the best sector this year? It could be because the new bill um, specified that companies can actually build new factories and deduct that immediately, which is a lot of times you have to amortize businesses over a period of time. So there's a huge incentive for companies to build in factories such as AI data centers, and that's why one of our focuses in our growth stocks now are AI infrastructure build out and kind of the build out of factories in America. Anything involving that is something that's going to be high growth this year. What other things are helping? Utilities are doing good. Perhaps that's part of the AI build out where utilities are actually in high demand for electricity. And we have materials. Perhaps materials are doing good because we have the dollar going down. So as the dollar goes down, um, the price of commodities goes up. So let's watch materials. That was one of the worst performing sectors last year, and it's starting to become a better performing sector this year. And utilities, let's look at financials. Um, at the beginning of beginning of this year, we said financials could be a clear winner from deregulation. And utilities, at the beginning of there, we said deregulation might help the utilities and artificial intelligence build outs are helping them also. Um, what other sectors are doing good this year? IT, it came back from a negative to a positive 9.4% this year. All right, so I'd say 70% of my portfolio is in IT, even though it might be overbought right now or overvalued. You have the highest growth rates in the IT world, so and most consistent growth rates. So let's look at one of the more disappointing sectors this year, real estate sector. It's not doing too good because interest rates have remained high. Um, Healthcare sector is still not doing so well because we're having threats on tariffs for that group, and there's a big we have Robert Kennedy Jr. being the head of the health department, and that really throws in the chaos vaccine manufacturers and a lot of the approvals for drugs. So there's a lot of caution in that sector right now. Okay, let's look at some of the stocks going up and down in the stock market now. Um, okay, we said let's look at the interest rates right now. Interest rates have been going up. Look at that, it's going up. So let's look at the yields of the 10-year going up. That's positive for large cap tech stocks, financial sector, insurance companies, brokerage companies, and insurers. It's negative for small cap stocks, high yielding stocks, home builders. Let's see if that translates to what's happening in the sectors. We have biotech. Okay, that makes sense because if the cost of borrowing money goes up, the biotech industry is hugely indebted and they need to borrow more money. So that's going to make them less profitable. Home construction, definitely affected by interest rates. As the interest rates go up, the demand for housing goes down. And home builders, similar to that. Regional banking, not sure why that's going down. Um, Financial select spiders. Okay, some of the financials are down this week. So telecom high yielding. So I guess you can say the banking stocks are high yielding, and so is the telecom sector. So as the interest rates go up, the demand for high yielding investments go down because you have a guaranteed yield in the 10-year versus um, an unknown with stocks you're taking risks. Let's look at the stocks. I mean, the sectors going up the most. Gold miners, we have metals, miners, and services. That kind of makes sense for with the U.S. dollar, going down in general. The price of commodities are going up. Let's look at and also we have to look at the price of the price of oil. Let's see. Okay, the price of oil is going up. Okay, so that would explain why energy stocks are going up. So it's like almost a one-to-one correlation. If the price of oil goes up, a lot of the energy stocks go up with it. Um, okay, so let's look at the market movers. We have a lot of energy stocks going up today. Halliburton is an energy. We have Schlumberger, SLB. They do oil drilling. And okay, we do have some stocks in this top 10 that are okay. Kraft Heinz. We talked about this 2 weeks ago as a high dividend stock. Um, and it with the total return maybe of 7 or 10%, but it actually said that it was in talks. Wall Street Journal said it's in talks to break up the company. So we've had a lot of breakups recently that turned to be successful companies like GE broke up, and we have Honeywell that's going to be breaking up. Um, so that brings them a little bit of excitement. Sometimes when you break up a company, um, the sum of the parts are better than the actual stock before the split. So people could get excited about that stock. Constellation Energy is a stock with an AI. Um, they have a lot of business for AI from the big tech companies. Um, Baker Hughes, they're an oil company also. That's one of the stocks we were following as an undervalued stock. And all right, that's all we can get from that. The top decliners, we see a lot of these stocks in the top decliners were stocks that ran up a lot and they're coming down as one like United Airlines. They were up 12% the other day. Now they're down 4%. Some profit taking. We have let's see, Caesar's the same thing. It went up 12%. Now it's down, going down a little bit. Okay, so I guess today was a day of profit taking for some of the stocks that ran up a lot more than the market. And okay, what you see from this top, these stocks here are a little bit more conservative stocks. You have no, this isn't conservative. MicroStrategy is is a Bitcoin oriented stock, and it's a total. It's a one-to-one correlation to the price of Bitcoin these days. Um, we have Constellation, big, a lot of the same stocks as the S&P. Alphabet, we're going to go over Alphabet later on today. Okay, that was a good little excursion. Let's go to the analysis picks from the beginning of the year. You can see Cisco is up 14%. That is his best performer this year. ADTN, another network play for the AI infrastructure. IJJ is only up 2%. This is the mid cap ETF and the banking ETF. This contains stocks for a lot of the big banks. It's up 12%. Cash, 4%. That was useful during April, but it's not a very good pick right now because a lot of the other stocks are going up. All right, so here's some charts that I saw that were interesting. We have this is the healthcare sector. It's been basically underperforming for the last 3 or 4 years. And as a contrary investor, you have to look at it to see if there's any value at all. Right now, we see um, it's barely going over its 20-day exponential moving average. It's starting to approach a lot of the moving averages. So we have just a little bit of momentum with this sector. And of course, this could be crushed, or any of the stocks that we're following can be crushed by tariffs that negatively impact earnings. So, but right now it seems like we have a little bit of momentum from the bottom, and A lot of times I look at the chart for the sector as a hint that we might be able to start dollar costing into some healthcare names. Let's look at Netflix. You can see that we're in an uptrend for Netflix. It's been one of the best performing stocks in the stock market this year. We have earnings coming out this Friday. So you can see it's starting to go down just a little bit, and we're almost to a point where we're oversold in the stochastics. So we do have earnings coming out. We have this um, channel that we're working with. So, if we have earnings and they come out and they disappoint, this could go down to this bottom end of this channel. Um, so we'll watch for that. But right now the stock is above most of the moving averages. It's has momentum on its side, and so far it's been a consistent compounding growth stock. Let's look at JP Morgan. JP Morgan is another stock. It's a little bit out of favor this week. You can see it's gone down a little bit recently. It's above all of its moving averages, including the 20-day exponential moving average. And it's definitely one of the stocks that's doing the best this year. It's in the financial sector, and it's starting to be just a little bit, it's halfway between overbought and oversold. So it's not at a buy point yet. A lot of times, whenever it gets down to the bottom part of the trend line, that's the time to buy it. Um, and let's look at Walmart. Walmart is in a well-defined trading pattern. We're nearing a point where it's oversold, and it's at its 200-day moving average and right in the middle between its trend lines. So as earnings come out, if they correct down to this bottom part of this channel, it could be a good time to buy that one. And let me see. Let's look at waste management. You can see that waste management is oversold condition, and it's at the bottom of its trend line. So it's a well-defined zigzag pattern, like a chainsaw, like a saw pattern, and it's at the bottom of that range. It's it's around 2 times overvalued, but they have a monopoly and they have pricing power. So they so that they're at a point, a good buy point, and they have a good dividend, and they're a stock that you can buy and hold for a long time. They might grow like 8% a year on average. And so what they're doing right now is they're buying small companies. Like they bought a Stericycle company recently, and that company allows them to um, have medical waste as a part of their business. So this is an example of a stock I'm buying and holding and um, collecting a dividend. It's more of a dividend-oriented stock than a growth stock. Okay, this is Walmart. We already saw that one. NVIDIA. We mentioned a couple of weeks ago about this well-defined base for the stock. We had a trading range between 155 and 100. And we recently, a lot of times if you have a good baseline, there's a saying, um, the longer the base, the higher in space. And we recently broke out of that base, and we're starting to go a little bit higher. Earnings for this company aren't going to come out until the end of the month, so another month. So it's going to be a while before we get earnings, but we're going to get hints from Taiwan Semiconductor this Thursday, and the CEO says a few things that could help us. But it seems like we're breaking out of that base that's been around for a long time. Um, and as earnings come out, if they there's a maybe a tweet from the president or something that causes consternation in the market, it might trade back into this range, this sideways patterns. But as earnings grow and as they um, continue to expand what they're selling, there's a good chance this stock breaks out of this and makes higher highs. All right. So Costco, you can see it's at the bottom end of its channel, and no one likes this right now. It's basically oversold, and this is probably a good time if you're interested in the stock to start buying it because um, I'd say they're growing between 8 and 10% a year in their membership fees. So they're growing their members by 8 or 10%, and that is 90% of their profit. So you have a sense where, but they're overvalued by like 2 or 3 times. So if they miss on their earnings in any way, they could break out of this beautiful pattern that's been in an uptrend for how many years. So, but right now they're at the bottom end of that range. So this could be a way to diversify your portfolio. Um, okay, so sometimes you wonder why I'm like doing these charts. Why am I looking at when is a good time to buy? When is, a good time to sell? What is the market going to do next? And the reason for that is, in general, we try to buy and hold quality forever compounders that grow at least 10% a year. We keep track of the fundamentals of those holds, and it's called buying homework. That's what Jim Cramer calls it. And you analyze the news every week to see if the news affects your stocks. So that's the first thing. We're trying to find growth stocks, and we're also trying to find dividend paying stocks that you can buy and hold. So ultimately, you're going to have a portfolio of stocks that are growing around 10% that yield maybe 2 or 3%, um, allowing you to like have a large income as your base is growing over time. So we want dividend stocks and growth stocks. I'm totally ignoring the bond world because I don't understand it. And we're going to use technical analysis like chart patterns to time our new buys or sells. So whenever I say we're overbought in the stock market, it's just it's just a time when we try not to buy new purchases, and we try to maybe sell some if we want to sell an item, a security. Um, it's not that we're selling out of everything when we're overbought. It's just whenever we have a little bit of money to buy, then we want a dollar cost whenever it's at a oversold state. So let's look at to review some of what makes a good growth stock for a buy and hold. The first thing is we have this high free cash flow. We like stocks that um, generate more money than their expenses. And we use the PEG ratio to determine whether it's on sale or not. A lot of the stocks we're following in our growth portfolio have a PEG ratio greater than 2, greater than 1 right now, and that's not so great. But in general, you pay more for a stock that is a better quality, high quality stock. Um, we have a couple formulas that we use here. Return on equity, we try to find it greater than 11. Profit margin, we want it to have it greater than equal to 11. We like to see larger market caps because they're a little bit more reliable. We like the forward PE to be low compared to its growth rate. And the growth rate we like to have greater than equal to 10 or 11. Um, and the PEG ratio, try to buy it when it's less than or equal to 1. Okay, so I did a stock screen this week, and I highlighted the best 20% of our 100 screen of 100 stocks, and I highlighted those in green. The next 20% I highlighted in yellow. So whenever you look at this, you know, um, spreadsheet, you're going to try to find the stocks with a lot of yellow and a lot of green combination. Like we have this is a lot of green, indicating it's a top 20% in that category. So, so that's how I basically look through and try to find some good stocks to buy. Google came up again as a top. I sorted this list by market cap. So this is the largest market cap here, but I just wanted to highlight, it's kind of still out of favor. It's down 6% this year. And whereas the rest of the market is up 7 or 8%. So we're going to go over Google because we haven't done it and we haven't gone over Google in a couple months. And we're going to go over Charles Schwab. And we highlighted this back when it was like $50 a share. It was kind of out of favor then, but I'm looking at it now because there was an article about the Oak Mark Fund, um, and I thought it would be interesting to go over that one. Other stocks that I saw here, I didn't have a chance to go over this week, but um, Newmont Mining, they're a gold mining company. They have a 0.7% PEG ratio. That's pretty good. And Freeport-McMoRan, they're a copper mining company, supposedly 15% discount. The great thing about copper companies in America, it's very hard to make a copper mine with regulations and opening new mines. So there's only so many copper miners, and the president just made a tariff announcement on copper. So that's going to really help the local copper makers. Maybe we'll go over FCX again another day. But let's look at, okay, here's an article. Why Wall Street analysts think Alphabet might be the most overlooked big cap tech stock. Okay, Alphabet is one of my biggest holdings. I think it's a great stock. It's grown like 14% for like 15 years in a row. And I like to look for stocks that are compounders, ones that are forever compounders. They'll grow like 10% a year. You can buy and hold. Um, so I highlighted some things here. The one big concern for Alphabet is AI could disrupt the company's core search business. There's been some channel checks that say that there's no effect so far to their search. This guy Mahoney says the perceived threat to search is overblown, pointing to Alphabet's robust business lines. They have YouTube, Google Cloud, and Waymo. So they're still growing like 20% in these different businesses. So even if search goes away and let's say ChatGPT takes some of their business model, I mean their business, worst case, growth in these other segments could drive the stock upwards. So this Goldman Sachs guy, he says Alphabet presents one of the most compelling risk rewards profile among the large cap companies. All right, so yeah, this Evercore guy, he says um, there's a slightly an uptick in volume for commercial search queries. So okay, so that, and we also have some very smart people that are holding the stock. So let's look at this Oakmark investor. This guy is really smart, and he bought Charles Schwab when it was earlier this year. He has Google as one of his top holdings too. So these are the top two holdings after AIG in his mutual fund. And he's a big banks guy. So he knows banks better than most people. And you can see he's like a contrary investor. He has a lot of banks. He was buying banks whenever everyone was selling them during the crisis last year with the Silicon Valley Bank going bankrupt. But he has oil. This is an oil company, Phillips 66. He has ConocoPhillips, high dividend paying oil stock. And he has a lot of, the rest of them are banks basically. And so we're going to go over Google and Schwab here. Okay, so let's look at Google's chart. You can see that we're down 6% this year, but we are in an uptrend. We're overbought right now, and we're halfway between our channel lines. And so the important thing for Google is we're looking at this. this 200-day exponential moving average. This is kind of a sign of momentum, and we're above that, and it's in an uptrend. So we're going to keep an eye on that, and we're above all of the moving averages too, which is also a sign of momentum. And it's down 6% this year, so and earnings are coming up in the next week or two. So we have a lot of catalysts that could help the stock. We have some of their Waymos being used by Uber, and it's turning out that their Waymo is one of the more reliable um, rideshare companies uh, in the world. So it's looking like that business is going to take off, and it's growing. So let's watch that stock. I'm going to go over the fundamentals just for fun. Um, the interesting thing we have is from this year to next year, it's only growing 6.1%. That is new. It used to be 13% almost average every year. So it's going to have a tough time between this year and next year growing, but then it picks up to 14% the next year. So I averaged this 16 and the 6 and 13, and let's say it's growing at 10% a year. The PE right now is 19. 19 PE is it's below the 24.5% S&P, so it's below the market multiple, and its PEG ratio is 1.4. So, but the interesting thing is they have $67 billion in cash, so that makes the PEG ratio just a little bit less, maybe 1.2. So it's an example of a permanent compounder, and they're building out. They haven't given up on the AI world, and they have a lot of clout. So um, we don't know if they're going to win or not. But let me see the pros. The market share hasn't changed yet. They still have over 90% of the search worldwide. There are lawsuits that they're a monopoly, so they could break up the company, and that maybe the sum of the parts might be worth more than the actual stock. But if they make them give up their Chrome browser, that could be a problem. Um, the cons, competition from artificial intelligence startups. That's the biggest con right now. And let's look at what Morningstar says. They said they're undervalued by almost 27%. So that's pretty encouraging. Let's look at what CFRA says. They have it as a buy, and the price target is 190, which isn't much above where it's at now. They said our buy reflects the free cash flow potential and 8 to 10% revenue growth throughout 2026. Um, Although we estimate the search and YouTube will see growth rates decelerate, we remain excited about secular opportunities and great AI innovation across all segments. AI overviews, circle to search, and video. We see cloud growth at least 25% and a slew of opportunities to monetize AI. So that is very encouraging. Let's look at what their fair value is. They say they're undervalued by 13%. So we have two companies saying that they're undervalued by 13% CFRA, and the other company says they're undervalued by 27%. Yeah, no, it's 27%. Okay, so let's look at their numbers. Yeah, they're a $2 trillion company. Their forward PE is 19. PEG ratio, according to Yahoo Finance, is 1.36. That's close to what our calculation. Profit margin, 30. That is 3 times more than what we're looking for. And return on equity is 3 times more than we're looking for also. The cash is more than their debt. So 67 billion in cash. That's going to help them a lot. And so if there's an interest rate fear and Google goes down, you can ignore that because they don't need to borrow money. And you can see they're making 60 billion in free cash flow, which is really good. It's one of the top 10 in the country. Okay, and you can see Oakmark Oakmark Mutual Fund has this as a top holding. And you can see that, let's look at all of these big mutual funds that we've been following have it as a top holding. So that's a lot of good confirmation that, these are companies with unlimited research ability. If they keep holding Google, it's a good sign, it's a good stock. So let's look at um, Charles Schwab. And okay, let's look at Charles Schwab. This is another of Oakmark Mutual Funds top holdings. So they've held this for like a couple years now. So let's look at it. You can see that we also have this pattern of a sideways, they had a trading range here. And recently they broke through this trading range. I guess during this time, you have this, um, you can see that they weren't affected much at all by this, tariff issue. Um, they were actually helped by the volatility in the markets in April. So if we do have another bout of volatility where the stock market goes down a lot, um, just remember Schwab benefits from that because there's more trading involved. Also, you can see that, so we have this, the longer the base, the higher in space. We see a breakout just like we did with the NVIDIA, and it's starting to break out of that, this base right here. And we have earnings coming out this Friday. So we're at the bottom end of this trading range if we're looking at this uptrend, and we'll see what happens next. So it's a let's look at the earnings estimates. You can see they're 25 to 26 growth, 25%. That is pretty good. And the growth the year after that is 17%. So their PE right now is 21, and their PEG ratio then is 0.84. Our calculation, it's 16% undervalued, not times. So you can see that Yahoo Finance thinks they're about 15% overvalued. Let me see. Let's look at their profit margins. That's 3 times more than we're looking for. And the return on equity is 14%. That's like at the minimum of what we're looking for. They have 20 billion in cash, which is really great. Um, and they have a dividend. Let's look at their dividend of like 1%. It's not that great, but it adds to your total return. So let's see what CFRA says. They have a strong buy on the stock, and their target is 102. They said our strong buy reflects Schwab's healthy capital position and growth trajectory. Cash sorting concerns have largely subsided. And with Q1 client sweep cash at $4 trillion. Bank supplement funding. Okay, they said the Ameritrade integration shows momentum and it adds to their clients. So that Schwab is expanding into alternatives and preparing for spot crypto trading, demonstrating its commitment to innovation and responsiveness to evolving market trends. Okay, so a lot of these trading firms are moving towards cryptocurrency and different ways to trade, such as portions of new companies, like alternatives, maybe companies that aren't available publicly yet. So there's a lot of innovation that can happen with these companies in that sense. But I think they make most of their money um, with order flow. So they don't charge for trading anymore. So they have to make money elsewhere. Um, so let's look at their fair value according to CFRA is 82. So they're overvalued by 10% according to CFRA. And Charles Schwab thinks, no, Morningstar thinks that they're undervalued by 13%. So they say Schwab dividend platform exhibits strength despite macro weakness. They say the shares are cheap. And they said the shares rallied 2 to 3% in April despite the broad market going down. So this is kind of a defensive play in an environment that could be crazy. Let me see. Okay, the thesis for this for Morningstar is the financial services providers are likely to consolidate over time, and that will help the company grow. So this company is acquiring, um, and they're adding services to all their clients um, as their client list grows. All right, so we can see the only fund that has Schwab right now is Oakmark funds. So we don't have as much confidence as we do in Google for buying a new position, but we'll keep an eye on that one. Um, all right. Um, one of the last slides I have here is when there are crashes of 10 to 20% in a short amount of time, there's usually recovery within 10 to 20% or within a few months. But the time of a stock market going up is much, much greater than the time that the stock market, we have bear markets. So just keep that in mind whenever you're investing. All right, I hope you enjoyed that talk, and um, I think that's it for now. Have a great investing week.